presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compac YouTube update for December the 8th, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, I want to remind all of you, just click on the subscribe button so whenever I post an update, you'll be notified and you can watch it at your convenience. Also, you can go to compac.com, click on Insights, and you can get a much bigger, lengthier version of this YouTube update with much more of an explanation that Javed and I do. It is a weekly podcast, only about 35 minutes or maybe a little longer, right around there, and it'll give you a much more detailed version of this YouTube update. Also, if you need help with your portfolio, just give us a call or send us an email. Looking at the numbers last week, we saw the S&P was up 0.35%, Dow was up 0.62%, NASDAQ up 0.93%, and the emerging markets were up 1.43%. For the year, if you look at the emerging markets, having a great year. NASDAQ up nearly 23%, S&P up 18.25%, and the Dow is up about 14.5%. So overall, a wonderful year we've had so far. But I think the market is now waiting to see what the Fed does on Wednesday. Expectation is they're going to bring interest rates down by 25 basis points. There's about an 87% probability they will do that. The same is expected for the January meeting. Between now and the January meeting, we should get an announcement of the new Fed chair, who is going to replace Jerome Powell. The question is then we'll have a sitting chairman of the Federal Reserve and one that is waiting to become chairman of the Federal Reserve. So it'll be interesting to see how that dynamic works. Looking at the markets last week, we saw the energy markets were down a little bit. They were up, they were the best sector, but we saw utilities down a little bit, down 4.5%. Oil continues to drift lower, which is at 59.68. Interest rates were up quite a bit, and I think we are seeing a little bit more pressure. We got the PCE, which is the Personal Consumption Expenditures Index. That is the inflation gauge that the Fed looks at, and that was just about as expected, but still running in the high twos. They are expecting it to come down to about 2% is what the target is for the Fed. So that put a little bit of pressure, but I think the market had come down a lot. We were at the lower end of the range. We dropped below 4% for the 10-year. Now we're back at about 4.16 today. It closed at 4.14 last week. That's what we saw. One of the interesting things that I saw in this chart that I'm putting out there is that 71% of the wealth in this country is held by the top 20%. But when you look at spending, they only spend 39% of the spending. That's what comes from the top 20%. While the middle class, which has got 26% of the wealth, contributes to spending more than 50%. So it's still the middle class that drives the economy. That's what we have to remember. And the middle class is getting squeezed, folks. We have to remember that. The wealthier are getting wealthier, stocks are going higher, real estate is going up, but people who don't have large assets in the stock market or the real estate market are not doing as well. The bottom 20% have only 3% of the wealth, and they contribute more than the contribution. They spend 9%. So it's here that we have to really, is where America, what drives America is the middle class, and we have to remember that the spending, that's what drives consumption, is what drives the economy. Looking at PCE, as I mentioned, it was up 0.3%, a little bit higher, 2.8% year over year. Target is 2%, what the Fed wants. But as I've said, that the Fed will let interest rates, inflation run a little bit hotter and still cut interest rates. That is what expected they're going to do on Wednesday. We'll have to wait and see what happens from there. Looking at this week, not a lot as far as economic data goes, but the big news is going to be the Fed and their announcement of the interest rate cut. But that is just about built into the market. Where we go from here will depend on earnings, will depend on how the Christmas season spending goes. Those are the two drivers. Looking at the market, we completed wave 3, which was right here. I was expecting a fourth wave pullback, which is wave 4, and then we get wave 5 to the upside. Expectation is that we should get to about 71.5 or close to 72. That is the target, 71.50 to about 71.75 is what I'm looking for on the upside for the wave 5 top in the market. But once we get there, then we're fully priced. Then we need something else to drive the market, and we have to get earnings, which we'll get in January. That'll really drive the next phase of the market, how the earnings go. Now, remember how the first week of January goes. That's how January, the rest of the month goes, and how January goes is how the year goes. So that is one thing that we have to remember. January is a critical month for the markets, and it gives us a good idea what to expect for the rest of the year. So we'll be watching the markets over the next 8 weeks or so and see how they do. Weekly S&P has completed the fifth wave. I expect a new high in the market right up around here, a little bit higher, and that'll turn into wave 5 in the market. NASDAQ, same thing. Target is about 25 to 25,500. That's the projection from the third wave to the wave 5 high. That's what I'm looking for. We're at about 23.5 today, so we could get another couple of thousand points in the NASDAQ on the upside before we see the fifth wave top. Interest in NASDAQ weekly, same thing. Target somewhere around 25.5 or maybe even a little bit higher. That's the projection from wave 3. Interest rates still stuck in this range of somewhere around 4.2 to 4%. We are getting to the top of the range now. That's what we've seen since September. The bigger range is about 4.5% to about 4% on the downside is what we're 3.8%. So we're coming up to the top about here. We should top out somewhere around 4.25. We're at 4.16 on the 10-year note. Gold had the wave 4, wave 5. We're just going sideways. Still expectation for GLD to get to about 420 or higher. We are about 384 today. So we could see another 10% or so on the gold market before we see the fifth wave high. That is the way I'm looking at the markets. ETFs still bouncing around here on the long side, still stuck in this range, and we need to break out to the upside. That's the way I'm looking at the markets today. I will be back with you next week. If you'd like to get a more detailed version of the YouTube, more detailed explanation of the market, what happened last week, what to expect this week, go to Compaq.com, click on Insights, and you can listen to the podcast. Click on the subscribe button here so whenever I post a YouTube update, you'll be notified and you can watch it at your convenience. If you need help with your portfolio, send me an email at invest@compaq.com or 800-388-9700. Give me a call. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moez Ansari, Chief Investment Officer of Compaq Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compaq Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.